So far as Trilogy is concerned, there's a couple of things which we've been very fortunate about. One is that in terms of our property trusts, we have very little exposure to office and next to no exposure in retail. Our premier property trust is actually the Trilogy Industrial Property Trust. And one of the things that's benefited from is low Australian dollar, but also high commodity prices notwithstanding COVID. And of course, it's involved in areas such as mining, manufacturing, and also logistics. And all those areas are operating notwithstanding COVID. I've got to say, thank goodness we don't have exposure to retail. I think it'd be quite a miserable experience at the moment if you owned areas in Queen Street Mall or Pitt Street Mall or anything like that. That would be quite stressful from the point of view that it's very difficult to know where those areas will be down the track. It's interesting, at the moment we're seeing the resurgence of neighbourhood shopping centres, and also regional areas. People are moving out there. But I've got to say, I don't know whether that's got long-term sustainability or whether it's simply a point of time this year. One thing I'm pleased about is our concentration in residential in terms of the Trilogy Monthly Income Trust, and that's where we lend money to developers and also builders, but also our property syndicates, which really have that industrial focus. I think industrial is most compelling. Look, it's like everything, one of the things we're finding currently is yield compression. And that certainly plays its part in the industrial property trust. In the past, when we were buying into that sector, we were able to buy on quite generous yields. Now, over time, those yields have compressed. But we like regional property, so we've got a significant number of properties in Mackay. We've just bought a property in Brisbane, and also we've got another property in South Australia. And we're negotiating on some other properties at the moment which will add value to the trust. But we do like that sector because, again, it benefits from low Australian dollar and also high commodity prices. One of the things which is interesting is the continued growth in China GDP. And we suspect that while China has obviously got issues in terms of some soft commodities and there's wine, etc., in terms of the hard raw commodities, there's still quite significant demand out there, and we think that will continue for quite some years. If we go back to 2007, we found in that time the typical, I think the official cash rate was 6.75%. Now, that's now 0.25% and likely to go to 0.1%. So that's a huge discrepancy from what it was just over 13 years ago. And yet, if you look at the returns in our Trilogy Monthly Income Trust, where we're lending money to property developers and also builders, our interest return is roughly the same. So back in 2007, we were charging interest to borrowers of about 9%, and currently we charge interest of between 8 to 9%, which is a total contrast to what's happened in the official cash rate space. But the reason for that is actually due to liquidity. So if you go back to 2007, you had banks providing more funding to developers and also builders. But since that time, there's been less banks, particularly following on from the Hayne Royal Commission, we've seen less liquidity in that market. And what that has meant is that because there's been lack of liquidity, we've been able to charge a higher price through to developers. And of course, that higher rate has flowed through to investors over that period of time.